Anticipated news events like data releases, central bank meetings, and elections, they can cause shifts in risk across asset markets. So how can investors track these patterns of event risk to help identify macro investment opportunities? Trading volumes in single-day S&P 500 options have been growing in recent years. By linking these options data with macro news release dates, we can measure how markets are pricing the anticipated risk of the event. So what have the biggest anticipated risk events been for stocks? Generally, it's macro data release dates that might shift the path of interest rates, financial conditions, or the growth outlook. Since the beginning of the monetary hiking cycle in 2022, that has reliably been on Fed meeting days. Above target inflation over the past few years has also increased the equity risk associated with CPI release dates. And last year in 2024, as labor markets began to wobble and concerns began to rise, so too did the implied risks associated with non-farm payrolls at the beginning of every month. If we sort this list of the most risky days for 2024, it's perhaps unsurprising that we see the November US election topping the charts. However, what was a bit more surprising to us was that 3 of the top 15 riskiest days for the S&P 500 were NVIDIA earnings release days. That pattern's continued here at the start of 2025. Single company corporate earnings don't typically influence the overall riskiness of a broadly diversified index like the S&P 500. So the rise of NVIDIA's anticipated risk for the whole index with 500 companies helps us to quantify how important the AI theme is for the US stock market. The bottom line, anticipated risks can shift market pricing for US equities. Understanding these shifting macro events that drive risk premia means that we as macro investors can better analyze what's priced by markets and position our portfolios accordingly.